Hello everyone. This is chapter 13 of our textbook, and it follows from what we covered in chapter 12. In chapter 12 we covered the first three steps in the purchasing process, and those were identifying the need, determining what we need to buy, when to buy it, what quantity to buy. And the second step is to issue a purchase order to a vendor. The third step is to receive the shipment from the vendor. In chapter 13, we're going to talk about two specific steps. The first being, of course, getting an invoice, and we need to verify it, approve it for payment. And the second is the actual payment processing or cash disbursement. The key things in accounts payable and cash disbursement is to eliminate as much fraud as possible, and that will be achieved by having segregation of duties, have manual and physical controls, and of course automated controls through the information systems as much as practically possible. But in general, we have to combine physical and manual controls with system controls. So again, the computers can help us handle repetitive processes. The actual accounts payable processes in terms of verification of invoice and payment or cash disbursement is pretty much the same for regardless of the source of where we bought things from or what it is that we are buying. So we can look at the invoice coming from the vendor, and it is processed by accounts payable. And once we verify the invoice and its validity, if we received what was on the invoice and so on, we then issue a voucher for the Treasury Department or the cashier to pay the invoice. So the main principle is, in addition to processing the invoice, verifying it, and paying, we need, of course, to record that payment in accounts payable ledgers and updated the general ledger. So this is the context, the two steps: verification of invoice and payment, and with all the different data storage and entities we are dealing with. In the first step, where we are trying to validate the invoice, we need to validate it against what we received from the vendor, what the purchase order we got from the purchasing department. If there was any returns or rejects, we need to make sure we know about those so we don't pay for that. So basically we are verifying for accuracy. And then once we verify and validate, we send the validation to record it in accounts payable, and then we send it to the GL and accounts payable records. In the second step, when we actually process the payment, of course we get the verified invoice, we get approval for payment, we select to choose when to pay based on payment terms. If, for example, we are entitled to some discounts if we pay within the first 10 days, we need to look at that and perhaps approve that, and so on. And then we make the payment. Now, making payment can happen in many different ways. Usually we don't pay cash. Sometimes we issue a check. Sometimes we do wire transfer. regardless of the method, we have to have documentation, and we have to have support for when we made the payment, the amount of payment, and so on. In some cases, we get non-invoiced payment processed. And in this case, it's basically either an interim payment or perhaps an expense report that may serve as for employees, that may serve as an invoice, but it's actually just an expense report. It's not an official invoice. And in addition to the the ER diagram that is highlighted in gray here, this is for the first 3 steps that we talked about in chapter 12. We add the 2 steps involved in validation of invoice and payment of invoice to vendors. And of course, again, there will be segregation of duties, and there will be approval in every step to make sure we are paying the proper amounts. Of course, if we are paying by check, there will be a sequential number for a check master file, so we can keep track of all the checks where there is no gaps. We can track wire transfer payment. Again, we assign it on a sequential number from the system to do the payment. Technology. How can technology help us? Well, in the process of actually producing an invoice and paying it, it can take about, if we use technology, we can reduce the cost of doing that, the time, the employee's time that do that, by 40% if we use technology or try to automate things. If we are using EDI, as in getting messages that for invoice, that's electronic, that can help the process to get the invoice faster from the vendor, and of course identify what needs to be done and so on. So EDI can help us get things happening quickly as well for us and for the supplier. Now, if we want to pay, we only pay what we received. This is called evaluated receipt settlement. So if we ordered 100 units of a product and we received only 80, we pay only for 80. This way, we only pay for what we actually received. There is no payment for something on back order or delayed. Okay, so e-payment, things like wire transfer, for example, again, can improve the efficiency by which we evaluate process the payment. Now, XML is just a different standards for exchanging data between companies. So like we learned about EDI, if I have a certain system and my vendor has a different system, the 2 systems don't necessarily talk to each other automatically. We have to use standards in the middle. So EDI is one, XML is just a different technology that does similar things. In business-to-business systems, if we are using a website that we do our purchasing through that website, that help with our efficiency for placing the purchase order and reaching an agreement to deliver and so on. Sometimes these sites also help us make payments. So we pay them and they pay the vendor. Some of these companies can be the VANs, the value added networks, that help us exchange EDI messages. They also help us process payments. So these 2 steps can be highly automated if we have the technology. And as you can see here, we can use the system to store the data, recall the data, verify it, and so on. What is not on that flow chart are certain things that we need to think about. For example, if the value-added network, or that company in between that process our payment to the vendor, maybe our banks reduce our cash account by the amount of payment, but the payment is delayed in getting to the supplier. So there will be a little bit of lag of time, and that if that's a month end, we may need to do some kind of reconciliation. What about allowances? For example, when we purchase something and we need to return something, or allowance to to reduce the price for some reason, or something broke in shipments, and so on. These exceptions are not on the flow chart, and we need to create separate process to handle those. Those will not be handled by the system automatically. The system can keep track of how much we returned, and so on, and how much credit we deserve to get, but it doesn't mean that we get those credits as we supposed to. So we have to make adjustments to the accounts based on returns and allowances, but we also need to verify that the vendor at their end have honored these things as they are supposed to. So there is no difference between their statement to us about what we owe them and our system saying what we owe them. Now, there is a lot of fraud that can happen in these steps. And of course, the easiest one is we need to make sure that the vendor we have in the system is a valid vendor. And it's not a fictitious company, it's a verified vendor, verified product received, verified services received, and so on. And that requires segregation of duties. The person who creates the vendor is not the same person who verify the invoice, and it's not the same person that does the cash payment. Not to mention that we can include a manager or two to give approval on those things. Now, sometimes there are fraudulent checks, forged checks, that an employee may make a check that looks like the company check, send it to the vendor, and then they take the actual check to themselves. And then we end up with an employee embezzling money from the company. Another one is the fraudulent wire transfer. Again, did we verify that the bank account we are sending the money to is the vendor's account, or is it somebody else's? Sometimes we have losses that are not fraudulent. So we may find discrepancies in payments, but they are not really fraudulent. They are just mistakes. People not intentionally caused a mistake to happen, and that may cause discrepancies or errors in how we keep track of our cost and cash flow and so on. So for example, we may pay the supplier twice for the same thing. It helps with ERP systems that they keep track of that stuff, so it sort of flags it that you cannot make second payment on the same invoice. However, if the invoice is for partial quantity received, and then the second time around we need to pay for a second invoice on the same purchase order for the back ordered stuff. But then when we issue the second check, we pay for the whole quantity, not for just what was on back order. So this is a human mistake, can happen, and the system may not catch it. So in this case, of course, it is not fraudulent necessarily, it just we need to catch it so we can reconcile the accounts. We use, just like before, the control framework, control metrics framework to identify the processes, efficiency, effectiveness, security, completeness, and so on. Once we do that, our goal has to be that we validate the vendor and we pay only what we're supposed to pay. Of course, all the inputs have to be complete. Make sure that we have all the data that we need before we pay. So for example, the purchase order number, the invoice number, the receipt document number, and we match all of those, and then we make payment. Again, the systems can be very helpful in making sure we pay only for what we're supposed to pay, and that completeness can be easily enforced by the information system. The same with accuracy. If there is no match between the documents, the system can easily compare and flag it as something that need to be verified. And these are the things we just discussed in terms of validation and in terms of matching documents. Of course, after the fact or at the end of a financial period, like a month, for example, we need to do reconciliation between the bank account, the cash, and what we have in accounts payable, outstanding, and what we paid, as well as perhaps reconciliation with the supplier or the vendor's statement. If they send us a monthly statement, we have to balance that or reconcile that with what we have in our books. This way, there is no discrepancy and there's no errors, and we can control the company money.